Here's something you might find surprising to kick things off. The largest solar panel maker headquartered right here in the US, and a really big player globally. It's First Solar. And they're definitely more than just a name in renewables. Today, we're going to unpack what makes them tick.
Exactly. This goes way beyond just panels on a production line. We're doing a deep dive into First Solar Inc. That's FSLR on the NASDAQ. We've pulled together, investment analyses, news reports, company filings, really trying to get the full picture.
Right. And our mission for this deep dive is to pull out the crucial stuff. We want you to understand First Solar's actual business, where they sit in this fast-changing solar industry, their financial health, and importantly, how these recent U.S. tariffs are playing out for them. So let's start there. What does First Solar actually do?
Well, they've got quite a history. Founded back in 1999, IPO in 2006. Their home base is Tempe, Arizona. But their manufacturing, it's global. We're talking Ohio, Alabama, Louisiana coming soon in the U.S., plus Malaysia, Vietnam, India. And they employ a lot of people, somewhere between, say, 6,700 and 8,100.
Okay, and it's not just making things, right? You mentioned an end-to-end approach.
That's key. They integrate their own unique thin film tech with huge manufacturing scale, and they even handle entire solar projects.
So how does that break down into revenue? Where's the money coming from?
Primarily, it's selling the PV solar modules they make. That's the core. But they also develop and sell entire utility-scale solar power plants. Big projects. Then you've got secondary streams, O&M services for those plants, power purchase agreements, sometimes consulting, even licensing their tech.
Yeah.
And a really big factor now for their U.S. side, those Inflation Reduction Act manufacturing tax credits, they're significant.
You mentioned their unique tech CDT thin film. That has some specific advantages, doesn't it?
It does. That's a major part of their edge. Cadmium telluride, or CDT.
Yeah.
It's known to perform really well in, hot, humid conditions, real-world stuff, and it degrades slower than many traditional silicon panels. Beyond just the modules, they offer the whole system, designed to construction EPC services, plus the O&M we talked about, a leading module recycling program, which is pretty important, and energy storage solutions too.
Okay, and scale-wise, we said they're a major player. Can you put some numbers on that?
Globally, yeah, they're a leader. And like you said, largest headquartered in the U.S., their capacity was over 16 gigawatts in 2023. And the plan, get beyond 25 gigawatts by 2026. That involves ongoing build-outs in the U.S. and India.
That U.S. focus seems incredibly timely, doesn't it? Especially with the IRA and those April 2025 tariffs on Southeast Asian imports.
Absolutely. It puts them in a really strategic spot. They can capitalize on this made-in-USA demand push and potentially benefit from, let's say, more favorable domestic pricing because of those tariffs on imports. Their CEO, Mark Widmar, actually highlighted this. He called them the country's only fully vertically integrated producer in the U.S. That's a powerful position right now.
So if you're a customer, why choose First Solar? What's their main pitch, their value proposition?
It's really a bundle of things. First, the tech advantage, the CDT performance and lower degradation. Second, cost effectiveness. They focus hard on lowering the levelized cost of energy, the LCOE. That's crucial for project economics. Third, reliability. For big utility clients, that's non-negotiable. And fourth, a really strong commitment to sustainability. They call it responsible solar. That means lower carbon footprint in manufacturing, that recycling program, and ethical labor practices. They've got RBA Platinum status.
That sustainability angle seems increasingly important.
It really is. It contrasts sharply with some of the, environmental and labor concerns swirling around parts of the traditional silicon supply chain. This focus on ethics and the circular economy, it's not just good PR. It could be a real differentiator, maybe even justify a premium down the line as scrutiny increases.
Okay, so Chapter 1 summary. Major U.S. player, end-to-end solutions, unique tech, revenue from modules and projects, and IRA credits are a big boost stateside. Makes sense. Now, let's shift to the people leading the company, the management team.
Right. Mark Widmar is the CEO. Under his leadership, we've seen some pretty significant things happen. Huge manufacturing expansion both here in the U.S. and in India. Tech advancements too, Series 6, Series 7 modules, something called CureTech. Plus they bought EVLR AB to get into perovskites, that's next-gen stuff. Financially, revenue's grown strongly, profitability's up, helped a lot by the IRA, obviously, and they've built up a really large sales backlog stretching out to 2030.
That U.S. manufacturing expansion, you mentioned it started before the IRA and tariffs really hit full force. That sounds like good timing or maybe foresight.
Definitely seems like strategic foresight. It gave them a real head start. Others are now scrambling to build U.S. capacity, while First Solar's already scaling up. It's paying off.
But it's not always smooth sailing. How have they handled bumps in the road? Any crises?
Well, there was a manufacturing issue with some Series 7 modules. Their response was pretty transparent. They owned it, explained the fix, set aside money for potential warranty claims. That builds trust. They also weathered COVID disruptions and the 2022 inflation shock fairly well. The stock recovered. And most recently, with these April 2025 tariffs, they were very proactive. Quick communication on the impacts, revised guidance, adjusted strategy like pivoting their India facility more towards non-US markets.
So even when the news wasn't great, like the tariff impact, they were upfront about it.
Yeah, that transparency and agility stood out. It's important for investors.
How's their overall communication? Do they keep investors well informed?
I'd say it's high level. Quarterly calls, detailed investor decks, SEC filings. They tend to discuss performance, challenges like that Series 7 issue or the tariff effects quite openly, and they provide regular financial guidance. If you dig into their SEC filings, the 10-Ks, you'll find pretty comprehensive forward-looking statements and risk discussions.
And what about the ethical side? You mentioned responsible solar. How does that hold up under scrutiny?
They really emphasize it, that Platinum RBA status for their factories is a big deal. It's about ethical manufacturing. They've gotten nods for human rights commitments, too. Sustainalytics gives them a low ESG risk score. Importantly, no major ethical scandals hanging over them.
What about insider stock sales? You sometimes see concerns there.
You do see CEO stock sales, but as noted, these are under prearranged 10b5-1 plans. That's a standard mechanism for executives to sell shares over time without it being seen as trading on immediate inside info. So overall, their ethical stance, especially on supply chains, seems like a genuine differentiator for them.
Okay, so management seems capable, transparent, ethically focused. Now, how are they using the company's money? Capital allocation.
A lot of it is going right back into the core business. Big money on manufacturing expansion, Ohio, Alabama, Louisiana, India, and significant investment in R&D. Improving their CDT tech, the CURE program, and that FSLR acquisition for perovskites. That huge U.S. manufacturing bet really underscores their confidence in U.S. demand and the IRA sticking around.
Any major moves in mergers and acquisitions?
Seems more opportunistic, focused on tech, like buying FSLR for the perovskite know-how. They also bought GE's CDT assets way back. It looks like tuck-in deals to boost technology, not massive consolidation plays.
What about returning cash to shareholders? Buybacks, dividends?
No significant buyback program currently, and no dividends paid. They've stated pretty clearly they don't expect to pay dividends anytime soon. The focus is squarely on reinvesting for growth.
Makes sense with all the expansion, but are those reinvestments actually generating good returns?
That's where ROIC, return on invested capital, comes in. And the trend looks positive. For the trailing 12 months in 2024, it was about 15.83%. That's up from 12.25% in 2023.
I see. So improving returns on their investments.
Yeah, there was an odd figure in 2022 because of a net loss that year, kind of skewed the calculation, but the recent trend is up. Long term, you want to see that ROIC consistently beating their cost of capital. That's how they create real value.
Right, so strategic reinvestment seems to be the name of the game, and early signs on returns are decent. Let's pivot to overall financial health, the numbers.
Okay, key metrics. As of early May 2025, stock price around $129.78. Market cap, roughly $13.9 billion. Their trailing PE ratio is about 10.75. That's actually lower than its historical average. Suggests maybe some caution from investors despite recent earnings growth.
Interesting. What about forward-looking PE?
Even lower, somewhere in the 7.6 to 8.6 range, depending on the estimate.
And earnings and revenue, how did 2024 look?
Strong year. Full year 2024 EPS was $12.07. Revenue hit at $4.21 billion. That revenue number was up almost 27% year over year. Pretty solid growth.
But you mentioned guidance was revised down for 2025.
Right. The consensus forecast for 2025 revenue got pulled back to a range of $4.5 to $5.5 billion. That definitely reflects the expected hit from the tariffs, likely pushing them to focus even more on decoupling and serving the U.S. market primarily.
And how profitable are they? Margins?
Margins look really good right now, trailing 12 months for 2024. Gross margin 44.2%. Operating margin 33.3%, net margin 30.7%. But, and this is a big but, you have to remember those IRA Section 45X production tax credits are giving those margins a huge boost.
Got it. So strong current profitability, heavily aided by the IRA. What about the balance sheet? debt levels?
Very conservative on debt. Debt to equity was super low at the end of 2024, just 7.64%. However, free cash flow for the trailing 12 months was negative about minus $308 million.
Why negative cash flow with good profits?
Mostly due to all that capital expenditure. Building out those big new factories costs a lot up front. Their price-to-book ratio is around 2.64. And we already mentioned that healthy 15.83% ROIC.
Okay, so currently profitable, low debt, but investing heavily, which impacts free cash flow. How stable has this profitability been historically?
That's a key point. If you look back 5 or 10 years, their earnings have been pretty volatile. There were years with net losses mixed in. The strong profits of 23 and 24 are very much tied to the current environment, especially the IRA. So while things look good now, you can't just extrapolate this level of profitability indefinitely based on history. Caution is needed there.
Right. No dividends, we know that. Debt management seems okay.
Yeah, seems conservative. Low overall debt. They've used some localized financing, like for the India plant. They generally carry net cash, though that cash balance has come down because of the heavy CapEx spending.
And managing day-to-day operations, working capital.
The peer is pretty sound. Current ratio is healthy, about 1.93. They did see inventory levels tick up recently, but they explained that as strategic stocking to meet future orders. Seems plausible in this market.
Okay, summing up financials. Currently strong profits and balance sheet, thanks in large part to IRA, but a history of earnings volatility and negative free cash flow due to current heavy investment. No debt worries, though. Let's move into the second half. How is the market feeling about First Solar right now? Market sentiment.
It's definitely mixed. There's a tension, you could say. On one hand, people see the long-term strengths, U.S. manufacturing, the technology, IRA benefits, solid foundation. On the other hand, there's near-term uncertainty, mostly around those tariff impacts on their international business and the revised guidance that came with it. The stock has underperformed year to date. You see some analysts with short-term sell ratings based on technicals, but maybe neutral looking out just a month or so.
What are analyst price targets telling us? Generally positive or negative?
Generally positive, actually. Most suggest significant potential upside from where the stock is trading now. Lots of outperform or buy ratings floating around. But there's a pretty wide range in those targets. That tells you there's disagreement or varying conviction levels among analysts.
Why the wide range?
Probably differing views on how well they'll navigate these tariff headwinds versus how big the long-term U.S. opportunity really is. It seems many are trying to look past the immediate tariff noise.
How have specific news items affected the stock lately?
Well, the tariff finalization itself initially gave the stock a bit of a lift. People thought, okay, clarity. But then came the Q1 2025 earnings and that revised guidance. That caused a drop. The reality of the international impact hit home. There's also still some lingering attention on that Series 7 module issue from before and ongoing focus on how they're managing supply chain risks. Overall, recent news has definitely added a layer of caution for investors.
What about short sellers or options activity? Any signals there?
Short interest has been creeping up. It was around 9.7% of the float in April 2025. That suggests more investors are betting a price might go down, likely tied to those tariff concerns. Options-wise, the put-call open interest ratio was slightly below 1. That might hint at slightly more call bullish activity, but it's not a strong signal either way.
Okay, so a mixed bag on sentiment. Long-term optimism wrestling with near-term tariff worries. Now, who actually owns the stock? Ownership structure.
Institutional ownership is really high, like 94.4%. That includes all the big names, Vanguard, BlackRock, often through index funds.
What does that high institutional ownership mean?
It suggests broad confidence, generally, but it can also mean more volatility if those big funds make large moves in or out.
How much do insiders, executives, directors own?
Around 5.46% held by insiders collectively. We mentioned CEO Mark Widmar's sales under those 10b5-1 plans. Also interesting, Farhad Fred Ibrahimi, who's known as an activist sometimes, recently trimmed his stake but still holds just under 5%.
Are those insider sales a red flag?
Sales under prearranged plans are generally seen as less indicative of the immediate outlook. It's often just portfolio management for the executive.
Is the ownership concentrated or spread out?
It's relatively concentrated among the top institutions. The top 25 own about 64% of the company. That concentration can mean those big holders are more engaged with management, which can be good. But again, large shifts by them can really move the needle on the stock price.
And any flags around corporate governance from an ownership perspective?
Sustainalytics gives them a low governance risk score, 5.2, which is good. And having large, sophisticated institutions as major owners typically encourages good governance practices. They tend to demand it.
All right. High institutional buy-in, some insider holdings, fairly concentrated. Let's pull it all together now with a risk assessment, a SWOT analysis. Strengths, weaknesses, opportunities, threats. Strengths first.
Key strengths: the proprietary CDT tech, leading U.S. manufacturer, vertically integrated here, strong balance sheet, low debt, big project backlog, leader in sustainability, responsible manufacturing, strong R&D.
Okay. And the internal weaknesses.
Weaknesses: that historical earnings volatility is a big one. Recent negative free cash flow due to CapEx, the past Series 7 module issue, some reliance on tellurium supply, and maybe becoming too reliant on the U.S. market if policy were to shift down the road.
Makes sense. Now, external opportunities. What's out there for them?
Opportunities, huge ones. The IRA incentives, growing made-in-USA demand, just the overall massive global growth in solar demand, potential for more tech breakthroughs, building out a domestic supply chain, the rise of solar plus storage, and crucially, those tariffs on competitors could actually help their U.S. market share.
Right. The tariffs as an opportunity in the U.S. And finally, the external threats.
Threats: intense competition, especially from China. Big one is policy risk changes in subsidies or regulations here or abroad. Trade disputes, tariff complexities are clearly a threat now. Economic downturns hitting project demand. Supply chain disruptions, commodity price swings, technology risk getting leapfrogged, and interest rate changes impacting project finance.
Okay, that gives a really clear picture of the landscape. Lots of potential, but definitely risks to navigate. So let's wrap this up. Can you synthesize the main takeaways from our deep dive?
Sure. Fundamentally, First Solar has a solid core business. Their strategic bet on U.S. manufacturing looks smart right now, especially with the IRA tailwind. But they are facing real challenges from these new tariffs impacting their international side. And you can't ignore that history of earnings being a bit up and down.
And those 2025 U.S. tariffs, just how big a deal are they in the grand scheme?
They're a classic double-edged sword, really. They create an advantage for First Solar's U.S. factories by making imports more expensive, but they simultaneously create headwinds for First Solar's own factories outside the U.S. that might have been serving global markets, forcing strategic shifts and adding near-term uncertainty.
If we put on, say, a Warren Buffett-style value investing hat for a moment, what might jump out about First Solar?
Well, you'd probably like that it's a relatively understandable business. You can see the long-term potential, though with caveats. Management seems capable. There's a developing competitive advantage or moat. The financials, particularly the balance sheet, look strong. Capital allocation seems rational, and the current price may be reasonable given the growth prospects.
What would be the main concerns from that perspective?
The biggest flags would likely be that historical earnings inconsistency value investors prize predictability, and the significant dependence on government policy, like the IRA and tariffs. Policy risk is always tough to handicap long-term.
So what's the final thought for someone listening considering all this?
Investing in First Solar today feels like a bet on a few key things. Can they skillfully manage these tariff complexities? Will U.S. policy support for clean energy remain strong? And can they successfully translate their tech and manufacturing advantages into consistent, profitable growth over the long haul? Now, the current valuation seems to bake in some doubt, which might spell opportunity. But that historical volatility and policy dependence, they definitely require careful thought and ongoing monitoring.
A fascinating picture of a key player at a pivotal moment. That wraps up our deep dive on First Solar, but we're not stopping here. Thinking about First Solar's U.S. focus and how critical policy is, our next deep dive is going to tackle the long-term sustainability of clean energy incentives right here in the United States. What are the different scenarios? What could the real-world impact be on companies exactly like First Solar? If you found this analysis useful, make sure you subscribe so you don't miss that exploration into the future of clean energy policy. And please also subscribe to the Stock Analytics AI YouTube channel for more market insights like this. Just a reminder, this conversation is for informational purposes only. It's not investment advice. Please always do your own research before making any investment decisions. You can find links to the sources we use, including those investment analyses and news reports, in the description.